Hello, my name is Adam with Infinity Accounting, bringing you another lesson in small business accounting, chart of accounts, and normal balances, which is the most exciting thing ever. Alright, the last video we talked about the different types of accounts. There are 5 different types. I just wanted to go over those real quick since it's been a while since I released a video. We have your revenues and your income, your expenses, your assets, which are things that you own, your liabilities, which are things that you owe, and your equity, which is capital in and out of the business. There are also 3 main financial statements that we use in accounting, which are the income statement, which is the revenue less the expenses equals the profit or taxable income of the business. There's the balance sheet, which is assets equals the liabilities and equity. It's also a snapshot of time, so basically it's the health of that particular business in one period of time. It's also statement of cash flows, which is the cash effects of your operating, your financing, and in your investing activities. So basically it's going to take all these 3 different functions, operating, financing, and investing, and reconcile it down to pure cash for a given period of time. So accounting is what I call, accounting is a double entry system, and for every entry there are at least 2 accounts that are affected by that entry. It's what I call the algebra principle when I relate to accounting. So basically when you learned algebra in middle and high school, if you did something to one side, you had to do something to the other side. So in that regard, it's similar to accounting where both sides must balance. In accounting, we use a system of debits and credits. The D.E.A.L means debit record, C.R means credit record. So debits are entered on the left side of an account, credits are entered on the right. I always compare the bank versus a particular business when I talk about accounting. So when you have a bank account, when you're debited money, you're basically, money's being taken out of your account. When you're being credited money, money's being given to you. However, when you're a business and you're doing accounting, you have to look at it from the bank's point of view. So when you're debiting something, if you're a business, you're basically receiving something. And when you're crediting, you're basically sort of money's coming out of the business. That being said, some accounts increase with the debit and others increase with the credit. I will get to that in a few minutes real quick here. Entries are represented in what are called T accounts. Basically, it's a T. I'll show that in a second. It's a visual illustration on general ledger accounts. Your general ledger are all the accounts in that business's accounting system. So for example, if you're using your accounting software, be it QuickBooks or Xero, and you go to your chart of accounts, it's basically going to list every single account that is in that accounting system. Here is just a visual makeup of the T account. I did one on Excel here, you can see. There's also 4 others. There's cash, salary payable, revenue, and rent expense. So you can see there's debit on the left, credit on the right. As I said earlier, depending on the type of account, it increases with a debit and decreases with a credit. We'll get into that further. So for debits, we remember the word D.E.A.L. Remember dividends, expenses, assets, and losses. And generally speaking, dividends, expenses, assets, and losses, the accounts will increase with a debit. Likewise, for credits, we remember the G.I.R.L.S. So generally, gains, income, revenue, liabilities, and stockholders and owners' equity are increased by credit. There's also something to be aware of called contra accounts. These are typically increased by the opposite of the main account. So for example, there's an account called allowance for bad debt, and basically it's a contra asset account. So basically, if you have that asset account, accounts receivable, for example, is the main account. Under accounts receivable, there would be an allowance for bad debt, meaning there's a certain percentage of invoices that you don't expect to collect during a given year, and that would be coming off the accounts receivable account. Alright, that's it for today. Next video we're going to go over the T accounts a little further. We're going to do some transaction flow, and we're going to actually see how these different accounts work their ways into the financials for a business. Just a bit of shameless self-promotion on my part. My name is Adam with Infinity Accounting LLC, as I mentioned earlier. We do small business accounting, payroll, tax, and we also are Profit First certified. So we do Profit First consulting on that. Here's my website, my email address, and my phone number. I'm usually available during the day, so just give me a call or shoot me an email if you need any help with consultations or anything like that. Like I said, and I just hope you're having a great day, and look forward to the next video. Thanks a lot, guys.